Hi, everyone. I'm Rick Bensignor. Today is Tuesday, June 7th. Welcome to this week's In the Know Trader show. What do we have on tap this week? Well, in the trader education segment, we'll quickly talk about being wary of the in-your-face supposed gurus who market to you constantly. And then we'll spend the rest of today's show doing a deep dive into the healthcare sector. We'll start off by looking at the XLV, the SPDR ETF that represents the S&P 500 healthcare index, and then we'll look at it relative to the S&P. In other words, its relative performance. And then we'll get into a bunch of names. These are the biggest names in the healthcare index. To sign up for my weekly ETF Tactical Trader Report or the monthly 7-Eleven reports, go to intheknowtrader.com. And let me give you a little details on that 7-Eleven report. That is a report that comes out at the beginning of each month and gives you new sector allocations across the 11 sectors, the 11 spider sectors, which are the macroeconomic sectors of the market. For instance, XLE for energy, XLK for technology, XLP staples, etc. There, as you know, there are 11 different sectors that make up the S&P. We put you in no more than 7 of the 11 each month. And just to give you a sense of what the results are, through May 31st this year, we are outperforming the S&P by 3.34%. That is 5 months into the year. That, in money management terms, is huge. And if you say, well, the S&P was down, you know, I don't know what it is down now. We were down almost 20%. Let's just call it down 15. And you're saying you're only down 12. You know, you're still down 12. Yeah. In the game of money management, if you're not in a hedge fund whose goal is to make money regardless of which way the markets move, but if you're invested in stocks, as so many of us are in our 401ks, et cetera, and taxable accounts, if you're outperforming the S&P by over 300 basis points in 5 months, you're just crushing it. Our fiscal year, which starts every August 1st, we're ahead by 4.37%. And if we go back to August 2020, when we started, in the 22 months since we started this 7-Eleven report, we are outperforming by 698 basis points. It's basically 7% in less than 2 years. That is, I'll say it for myself, that is actually phenomenal and puts me in the top 10% of all active money managers who play this game, which is virtually every every mutual fund out there is basically fully invested and looking to beat the market. And of course, there are a ton of ETFs that try to do this too. We actually do it. It's totally transparent. If you're interested in the report, again, comes out the first trading day of it comes out the last trading day of each month. So you have the proper allocations for the next month. Go to intheknowtrader.com and look to sign up for the 7-Eleven report. Lastly, I want to share with you that I'm going to start my own In the Know Trader YouTube channel very shortly. So if you like knowing what institutions are doing, where they're doing it in the market, and when they're doing it in the market, then please go and follow that channel now, even though I haven't officially launched it. Go to In the Know Trader on YouTube, and I just set it up today. You can start following that, and I will shortly be putting and doing videos for that new YouTube channel. Okay, let's talk about some of the characteristics of the daily emailers and constant social media posters who bombard you with information all the time. Here's what I find about those people who, and let's start off with, you know, the daily emailers, the people who put out an email at some subscription service, and every day they're in front of you with some email. They are almost always light on content and very big on long-winded talk. The amount of useful information that comes out of them on any given day is barely 1/10 of all the information that they've put in front of you as far as words and everything else. So something to notice and something to be wary of are the people who put out daily emails in this business. Secondly, They're very good at reminding you of their winners, such as, oh, 2 months ago, we told you to buy XYZ and notice XYZ is higher. They're terrible about telling you about their losers because they completely take them out of the conversation. If they gave you a bad trade, which they do all the time, they never remind you about it. It is simply gone from the conversation. It's something else you need to pay attention to of these people who are daily emailers and constantly. The same thing for those who are posting all the time on social media. Me, I avoid them completely. They generally have no published, verifiable public track record. They talk about how successful they are, but there's no proof they are. The other day, I saw something about a conversation with somebody who they said was one of the best technicians out there, and yet there's no proof that this person is actually very good or not. There's just nothing out there because they're on TV a lot, but there's no proof that you actually make money with any consistency listening to what they say. And lastly, these people will talk to you like they're an expert, but many of them have little or no industry experience. Some do, but several don't. I've seen those who said they ran a hedge fund, 15 years ago, but then if you look, the hedge fund never actually launched, or it lasted 2 months and disappeared. Many of these people never even worked with any real serious job on Wall Street. They're simply marketing gurus. And that leads me to actually the last bullet point, which is that they're terrific marketing gurus, but they're not market gurus. You will not likely make money with them over time, certainly not more than the S&P would return you if you were simply in a passive index fund. So all in all, just be really careful about who you listen to and pay attention to how they try to market to you. And if they're in your face all the time, constantly putting up stuff on social media, then they're all talk and they are not generally the type of people you'd ever want to follow. There is nothing behind them except a whole bunch of hot wind. All righty, I've said my piece. Next. Let's take a look at the S&P macro sectors. Now, I purposely only did month to date. Today is only June 7th. There have only been a few trading days, but I like to look at the month to date early in the month because it often gives you a good clue as to what institutions are thinking to start off the month. And here, what's interesting is that we've taken the S&P out of this. So all these stats are relative to the S&P. So for instance, energy is outperforming by 281 bips as of yesterday. Still the best performer on the year, best performer over 12 months, best performer on the month. That's been consistent. But what's interesting is that we're seeing industrials and materials also doing well early in the month. And the worst performing fund of the 11 macro sectors is healthcare, which you wouldn't particularly expect unless you thought that the market was going to rip to the upside, which there's still no indication that that's going to be. I do like that the market turned around from the week opening today, but the fact that healthcare and then financials are the two worst performers is suggestive of a market that is questioning how much more we have to the downside. Staples, you see, are underperforming too. So I'm not going to expand upon this more other than early in the month, it's a good idea to take a look at how the 11 sectors are doing, because it often gives you a pretty good clue of how people are positioned for the month ahead. All right, let's take a look at some charts. And we'll start with XLV. This, again, is the S&P 500 healthcare ETF. So what's most important is somewhere right around 125. We have all these lows going back. In fact, I could even extend this line. Might as well push it back here. We've got multiple 1, 2, 3, 4 lows against 125 in the last year. Pretty significant. We did make higher highs going into the April high here. So this year we even saw highs take out the January highs in healthcare, which made it one of the better ones for the year. But you've seen it's pulled back. And the most important thing I'm seeing now is that it's now 3 weeks in a row that we're holding above here. Let's see if I can pop on that level. There we go, 129.52. That is the bearish propulsion level. That's a level that if we properly breach on Friday closes, it increases the odds that you get a new move down to the next lower level, which in this case, it's hard to see. It's actually, let me take these trend lines away. It would suggest that a breach of 129.52 gets you right back down to the 125. Getting Friday closes beneath that then says that we'd get down to about 116, and that would put in a more significant top. That would be troublesome going forward. So healthcare is still hanging in there. We haven't gone through this sector in a while, so I figured it's time to go through them. And let me just zip through a bunch. Oh no, let's do one thing. Let's do the relative performance, and then we'll zip through a bunch of charts. Here's healthcare versus the S&P. The fact that we made higher highs and then pulled right back down over the last month had me lower my exposure to it. I'm still overweight healthcare, but I did lower exposure to it. And we went into healthcare, just to give you a sense of how good we timed this, February 1st. So right here is where we went into healthcare, and we lowered it on June 1st. So we took out a good piece of the outperformance that we've seen since. Let's take a look at some of the big names in the sector. Let me start here. Let's see. We'll do UNH, and then we'll go back to J&J. These are usually go neck and neck with each other as the two best performers in the sector. So these are outright charts. Here, United Health has pulled back like the market did. It's kind of mid-range here. Now we're still beneath the conversion and baselines, so that still keeps some near-term pressure on it. If we can't get back above 508 or so, then it would say that we could still test down towards the lows that we've seen certainly recently. These lows, the lows for the year, were made early in the year. So generally, look, you're above the cloud. Generally a good chart, but having some issue. J&J, probably not going to look all that different. Let's see. It actually does look different. You've got a flat cloud going forward. You're not nearly as above. You topped on a 13. Same way we topped on 13s here. Those are exhaustive signals on Tom DeMark's models. That's very institutionally followed models. The fact that we're getting some resistance here right against the conversion line the last couple of weeks still puts it somewhat sideways, but it's more vulnerable. And notice how thin the cloud gets going forward. This is weaker between UNH and J&J. I'd certainly be leaning towards UNH. Pfizer, similar chart to UNH in the sense we're above the cloud, not by a heck of a lot. Made the highs back here in fourth quarter last year. Kind of no man's land, needs to get above 57.5 on Friday closes to have a chance to break out towards the upside. And a bigger picture, needs to hold about 42.5 or so on the downside. AbbVie, weaker chart here. Now look, we bounced off of the conversion line. We're now beneath it. That's going to put resistance, I'm sorry, the baseline, that's going to put resistance fairly strong up here against the conversion line, which is going to start falling in a couple of weeks. 13.9 on the high, so you could get somewhat defensive on AbbVie. Lilly, one of the better charts, decently above its cloud, pulled back from the 13, hasn't been stopped out yet, so this needs to hurdle 338 and change to really get out of the context of the heaviness that exists from the 13. As long as it stays above 296 or so, it's decent. TMO, Thermo, one of the weaker charts we've looked at, hanging on to the bottom of its cloud, multiple, 6 weeks or so, we're hanging on. If we get consecutive Friday closes beneath 546, look for it to drop down to 520, if not even further. So that one's kind of more on alert. We'll do just a few more. Abbott has already broken beneath its cloud. If the lagging line, this blue line here, which is current price, pushed back 26 bars. If that breaks beneath, so if price breaks beneath 107, that structurally changes this, and that would put it into much more of a bear market. So this one is really one to pay attention if you're long for downside under 107. Danaher, price is broken beneath the cloud, held against its TDST line. Lagging line still above it. New lows here would be dangerous for this. So I'd watch out if we made new lows under 243. Look for pretty decent resistance now up at 282. Two more. We'll do Bristol. So here's BMY, one of the better ones, well above its cloud. Has a aggressive combo 13 on the highs. Has basically gone nowhere since, as long as we keep the Friday closes above the conversion line here in pink, 75.98, we're good. Well, if we get to, I'd say 2 Fridays in a row underneath, look for move down to 73. If not, 68-ish or so, and a bigger decline. Medtronic, worst chart we've seen. However, potential downside exhaustion here. If you like the name, you could start thinking about buying this and swapping this out for some of the other names that I said are vulnerable. This is already broken somewhat. I can't define it as a bottom yet, but institutions may very well start liking looking into this. And the last one we'll take a look at, finish up the show, is CVS. CVS topped on a 13.9, has brought back over the last few months. We're getting closer to the cloud. Look for, if I was going to be a buyer here, I'd probably look right around 91-ish or so, and I'd want to see 91-ish hold. Otherwise, look for the mid-80s next. That is it. Hope you enjoyed the show. I'm Rick Bensignor. This has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.